Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They are for information only. And a look at what we're doing in our portfolios. I always start here with the weekly chart of the S&P 500, and it goes back here to 2020 here on the left side. So we're getting almost 6 years here. Obviously, recently we've had quite a tumultuous market. Here is the nice uptrend that we had through 24, nice rally there. And then, boom, as these tariffs became unrolled, the market certainly had a reaction to it. We'd highlighted in past reviews that the market was very overvalued, so in need of a correction in terms of value, and it looks for a catalyst, and this was a big one. So we did have a breakdown on the weekly chart. And then what I do below that to find out where we might be stopping is I put some support points, points where the market had stopped before. Might be things that traders are looking at to say, okay, this is enough, or this is where I'm going to step in and buy. And you can see we had a couple here that, the peak from 22. So former peaks tend to be a nice draw, or the low there for 24 from last year. And it looks like both of those, maybe we got a little bounce there. Certainly this bounce that we had yesterday that amounted to 10% on the S&P 500 was because the tariffs were, it was announced that they'd be delayed for 90 days. So, and again, that's where a market that's very, very oversold, we were down 20% from the peak, is looking for a reason to bounce, and it finds it and does that. So that's where we are, recovered, gosh, close to half of what had been lost over the last few weeks. So now we're sitting solidly middle range, and as I said, put some support points here where market might stop, or even on its way up where it might stop and try to go lower again, and it generally will retest areas that it stopped. Like I wouldn't be surprised if we go retest down here again to make sure that that's the bottom. So that's the weekly chart. Obviously, we as it broke down, we were defensive, very defensive in terms of our portfolios. Come down here and look at in more detail here. This is the daily chart of the S&P 500, and this will give us, here's the dates here. This is about the last 2 years of trading. And now I've drawn a trend line here for what we're looking at on the way down. Still just got very, very oversold the other day, and was looking for a reason to bounce and probably at least, come back to at least its trend line, and then see what happens from there. But for our purposes, the market in the weekly chart, the daily chart, still in a downtrend. So until the market can prove that it's out of that, we would play that accordingly, and be staying very conservative with our investments. Here, if we come down to a 2 hour chart, like to draw the kind of the trend channel that it's going through, and you can see here through November, December, January, February, we've just been sideways. Market was overvalued and going sideways, and that's one of the ways that market can deal with an overvaluation. The other is that it can go down. And that's what it did. So here's the channel that we're getting. I mean, it actually had just really oversold itself in the last couple of days. So now it's recovering a bit on that news, and we'll see if this downtrend continues, or it's going to try to make a trend change and go higher, and that ultimately this 5,000 area was the low. That remains to be seen. If we look at some of the breadth measures, these can often give us a little heads up. And I had highlighted this in previous videos that, like, as we went sideways here, you see we're up at the all-time highs there, the 6147. Normally, this is the percentage of the S&P 500 that's in an uptrend, and normally we would see that in the 80s, 90s when you're hitting an all-time high. And here, December it's 70, February 58. March 53. So I guess we had already started selling off there, but as we were at these highs, you had almost half the S&P 500 was not in an uptrend near all-time highs. That definitely tells you something's up. In the same way, this next one down is the advanced decline line on the S&P, or on the New York Stock Exchange, and you can see it just the volume's coming out of here. It just got flatter. It told you which way it was heading. And then finally, the bottom. This is the VIX, the volatility index. This basically reflects the price that people are paying for puts, which are an option contract that makes money when the market goes down. Um, Generally, when you see a big sell-off, here through March as the market started to fall, it's 28. You can see this when you get little sell-offs like here in December and March, and it's muted. It's not really high. What you're generally looking for when the market bottoms is a big spike in the VIX, and we got it. It nearly doubled here in just a matter of a week, and that's what you're usually looking for, the market to wash out and really get slammed, and that's what happened. Not saying that this is necessarily done yet, but that's something that we would look for when trying to say, hey, the market probably bottomed here. So meantime, everything, all the charts, and that's what we tend to follow. Look at the economic picture as well, but if you follow the charts, they don't lie. So you're never on the wrong side of the market. You're just reading how it's behaving. We come here to interest rates. Again, I mean, we had a it's been an interesting week or so, pretty volatile in interest rates. They had been falling. We got down to about 4% on the 10-year U.S. Treasury, and then had a pretty big spike up to 4.3 here. But if you step back and take a look, now this is 10 years of the U.S. Treasury rates, but if you look here for 2 years, 3 years, absolutely the same range. We're just in the low 4% for a 10-year rate, so nothing really has happened there. It's just right back into that range that we've been sitting in for a couple of years. So nothing on that front just yet. If we look to economic indicators here, payroll numbers, the jobs, actually decent, 228,000 last report, which is higher than the one before that. Still positive, fine. Now these are backward looking. They're from some time ago, but still we haven't seen data that says big jobs recession here. GDP growth rate, same thing. These are not great numbers. It's but mid twos. It's what we've been used to for the last number of years. So these are fine. Nothing terribly wrong with them. Inflation. Maybe falling a little bit and not dangerous, so that's a good thing there as a mid twos. And then finally, I like to look at retail sales, a little bit positive. The last reading had been negative, so I'd say overall these are not fantastic, but nothing to look at and say, okay, it's terrible. But the market's always looking ahead, so it's looking at those tariffs and say you get a global recession and trade shuts down, sort of. That would have a really large effect on these numbers. So it remains to be seen whether that'll happen or whether this was all just a negotiating ploy. We'll be all watching closely. Come here to the forward estimates for earnings for the S&P 500 here, and analysts are still saying that the S&P companies are going to be earning very well going forward. So not seeing anything yet where analysts are saying, wow, this is going to be a real turn down for these companies and they're not earning money, which definitely will tell you that, hey, we're going into a recession. So not really seeing any signs of it other than what the market itself is doing. But if you take a step back here and look and say, hey, we had been rallying here for almost 2 years since late 23. The market absolutely needs some time to digest those gains at times, and it's looking for a reason, and it certainly found one. Finally, if we come to the valuation, this is what I've been showing for quite some time that was a problem. This is if we look here, the red number here, 4203, this is what the S&P 500 would be valued at, or would be trading at if we were at 20 times earnings, which is probably somewhere around normal. We had been up to 6,000. We were way past overvalued on the market. Certainly this helped to move us back into line. And as you can see, if you look back at the chart, eventually the market does tend to revisit numbers over time. It's not a timing indicator, and no one can say when. But it does not grow to the sky and keep going. Eventually, it will have its move down to catch up where it should be, and maybe that's what we're seeing right now. So to summarize, sure, we have a breakdown in the market. It's been very, very steep and very quick. Went to retest some levels that we had here, and then it really remains to be seen where we go. But for the time being, remaining conservative, because there is a good chance that we could just revisit these numbers down here. So we're still staying very cautious on the market, holding quite a bit of cash. So hopefully this was helpful and informative. I'm going to put up our contact information here. If you'd ever like to learn about what we're doing to protect clients during downturns like this, and how we manage, please don't hesitate to reach out. And again, I hope this was informative and helpful, and we will see you at the next update. Thanks so much.